Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're going to focus on the economy. We're going to look at some different interesting data points that we're looking at on the consumer side, consumer spending, what is happening on employment, and then really going into the import-export market on a global level to see where are things going, what is GDP really going to look like on a global level. So here we can see really just kind of honing in on Homebase. And Homebase has a great collection of data that just looks at hours worked by small businesses. We're looking at different employees. We can kind of look at this on a state level or on a nation level. So this is looking at the national level. And you can see how things have really started to roll over. And we don't think it really continues to go down too much, because even though you're starting to get some rollbacks, people aren't really accepting some slowdowns the same way. You have an adjustment, people are acting more cautious. So even though you get a pullback, we don't think you're going to come back to obviously those April lows, but you can see we peaked, things started to normalize, and now we've taken out the lows. And now at this point, we think that we're going to get a new normal, really kind of a little bit lower from where we are right now that are going to go up and down as we see employment. And what does this mean? This just means that there's going to be a little bit more people who are furloughed, some people that came back into the, restaurant, just different industries are going to go back onto some form of unemployment as these jobs start to, go away, or they just, get unemployed again, unfortunately. And that's why when we look at consumer spending, you have to see look, we bounced really hard coming off of April, which makes a lot of sense. We were in max lockdown. Everybody was bought in on, distancing, flattening the curve, and now we're coming out of it. But as you can see from the kind of where we peaked and started to come back down again, you can see that was when, there's some new COVID spreads, there's some adjustments. So these are things that we think are going to kind of, let's just say go to the right at this point. We don't think we're going to get back to that pre-level, but it's going to be hard to say we're not going to come, that we're going to come all the way back, especially given the spending. We had Best Buy announce better sales, Whirlpool, so people are spending. Things that were delayed are starting to come through. But again, those are big assets that are purchased 1-2 times and then you're done. And that's why the bigger focus now that we talked about with Seema Shah on one of our conversations was, what does back to school look like? What does spending look like? Especially we have more people that are going back on unemployment, and what happens if those payments start to adjust, which we'll talk about in a minute. So looking at this, you have to use the control group, which is looking at things a little bit differently, kind of being a bit more agnostic. And you can see it obviously bounced back really hard, came back quickly. But again, there was also a huge amount of cash that came into the market to help supplement some of those damages. So you get the quick lockdown, and now you have people that are starting to feel a little bit better. But now when we talk about feeling a little bit better about employment and you're starting to see employment roll back, well, what happens with payments? And here you can start to see kind of a mix of what the different compensations are, other incomes, and then unemployment benefits, and then different transfers. So like the chart on the left gives you a breakdown, looking at things from a January, February in terms of before we really had a COVID impact. You can see that March started to slow, and then April and May was the big drop. And you had this pickup in terms of what the government stepped in and provided a benefit for. So here, in April, you got the one-time 1,200, that took you above the January levels to give you a little bit of a bridge, which was assumed to kind of bleed into May in terms of those other transfers. And then you have those increased UI benefits, which equated to about $600 per week. Now, those are things that are coming into question because they're supposed to expire. If you switch to the chart to the right, you can see that the UI or unemployment benefits that top up, which was that 600, goes away. Now, it's just supposed to expire. It can be extended. There's conflicting information where the White House says it doesn't want a patch. Congress, Republicans want to just put a quick patch, call it a month of that extension until they can get a longer deal done. The longer deal keeps coming back and forth. The Democrats have talked about a $3.5 trillion deal. The Republicans have talked about $1 trillion. It'll probably be somewhere in the middle. And it seems like both sides are starting to agree that 600 may not be necessary, but instead walk it back to 400. But again, people need this money, and what happens to spending if this money doesn't come in? And I think we've clearly seen what happens when people aren't spending, as we saw with a huge drop in March. And then that recovery in April really came on the back of that 1,200 and some of those additional benefits. But then you have to consider, what about the older societies? What about people that are at risk or at a higher risk because of the COVID spread? And this looks at it from a global level. Let's look at it from Japan, Italy, Germany, Spain, France, United Kingdom. The top numbers in terms of just where is spending, where do they sit on the OECD G7 level in terms of economic just growth and just the economic engine of the world, really. There's an older population. These are people that normally spend, normally go out. Now you're starting to see that adjust. The United States is right there with about 20% of the population, 65 and older. This is going to be a problem and will weigh on spending overall, especially as you have some COVID issues resurfacing or surfacing for the first time, depending on where you are, and will impact spending over a shorter period of time. But again, this will impact spending, and the consumer is a huge part of the GDP number within the US, give or take 70%, depending on what we're looking at. And this is why, when we look at initial claims for unemployment, we're at 51.2 or so, 51.3 million people that have initial claims. Now, given initial claims is different than continuing claims, but it just gives you the size and severity of the impact this has had. And now we have new furloughs coming through, people getting new issues in terms of, permanent layoffs or just back to the unemployment line. And that's why we think we're going to get the stickiness in terms of the initial claims, which is going to be a huge weight on spending, a huge weight on investment, because are you going to invest in business if you're firing people and you're concerned about cash flow on a corporate level? And this is why we continue to see an economic slowdown, especially coming off of 2019. It's not like 2019 was a great stellar year for a lot of key economic indicators. But again, this unemployment number is going to be a problem as we go through the end of the year. Now, when we look at some of these charts that you probably have seen in the EIA, we're going to look at them a little bit differently. Instead of talking about how is this going to drive gasoline, jet fuel demand, we're going to look at what does it do for spending? What does it do for employment? This is the TSA passengers really showing you people aren't traveling. People are not being tourists. People aren't going to local locations that rely on tourism to really drive revenue. I mean, how many restaurants, bars, places open on a seasonal level, call it 4-6 months out of the year, that just won't be able to survive just because no one's showing up. You might have locals that might show up because it's a driving distance, but nobody is flying to those levels. And this is something that's going to be on a continuation. And then let's take it to the next level. What about the corporate traveler who is using a corporate card, so doesn't really care what dinner, or let's just say for those that are watching this under a corporate umbrella, they do care about what they spend on dinner. But you have an allotment, you have some ceiling that if you are below it, above it, as long as it's within this number, you're okay. This is money that's coming out. These are different things that rely on conventions and other things that just isn't going to happen, or at least not over the next 6 months. And again, the mobility data, you're looking at grocery stores, retail, transit, workplace, are people going out for lunch during while they're at work? The answer is no. These are things that are going to continue to impact the employment of these locations that rely on a healthy lunch schedule, that rely on their regulars. And that's why we're going to continue to see this remain well below average, because you're going to have closures, and those closures require people to man the stores, which are going to go into the unemployment line, which is going to make competition higher for other jobs. And that's going to be a rolling issue. Now, let's look at OpenTable. Again, OpenTable, looking at it at a global level, these are restaurants that don't have waiters, waitresses, busboys, sous chefs, additional people in the kitchen. Like, these are real jobs that have kind of normalized and hit a level where we're not going to see this come back in the same way. And this is real job. Like these are people that are just, it's a huge part of the industry. I mean, if you think about how many jobs this equates to in the US, is it 8-10 million? Like, these are people that are just not going to come back, at least in the next 6 months, just because COVID remains an issue, especially in close quarters. So again, these are things that are continue to weigh on employment, that are going to continue to weigh on the economy, because you just have people, if you're closing down, what are you not paying? You're not paying taxes. You're not paying all of these key components for society. So what does that do to property taxes? Do property taxes have to go up? The answer is yes. So then it's going to put an even more onerous weight on the people within this location, which may not have a job or concerned about their jobs. And this is something on a global level, just looking at the meat of it, 60.5% down year over year on just OpenTable. I mean, this is something that's relatively consistent. I mean, given you have ebbs and flows, because you have to take, Friday, Saturday, people go out more. But even on Fridays and Saturdays, you're getting to only a negative 55%. That's not something that's sustainable for the market. And it's going to be a problem for, again, taxes, employment. And the last thing to wrap up before we start going into a bit more technicality on the ECB and the Fed is rolling back of reopening. So these are real problems. And this is, if you look, this correlates very closely with some of these roles in home base and a lot of these different locations. And you have reopenings on hold, an increase in restrictions, and this is something that's going to remain through the end of the year. Then the question becomes, well, what happens when kids don't go back to school in September? They're working from home. They have to do Zoom now. Does the parent have to work from home? Do you share who goes to work, who doesn't go to work? These are real problems that are going to have a very real impact on people's discretionary income as we go through the end of the year, which is why the Congress is looking to act to kind of supplement some of those unemployment benefits at this point in time. I mean, just to summarize what we've really talked about, we have 75 to 78% of, by population that are either within the U.S. that are now facing either renewed rollbacks or of reopening, or just put on hold. And I mean, that's why we're seeing OpenTable show 65% year over year slowdowns in OpenTable reservations. It's why we're starting to see a slowdown in those employment numbers on the home base level, who's going to work. These are the things that have required fiscal stimulus. So now it's important to appreciate, okay, well, that's fiscal stimulus, that's unemployment benefits. Those are things that the government is trying to do to stimulate the economy. But now we have to really consider, well, what about monetary policy? What's happening on the other side when we look at central banks, which have continued to just pump in as much cash as they possibly can to try to stimulate some form of recovery by trying to reinflate some of these bubbles that we've already seen. And there's no place better to start than looking at 10-year Treasury yield. And that's why when we look at the 10-year Treasury, and this is a great chart going back to 1790, if you want to consider when the U.S. became the U.S., you can see this is the lowest in history. And the reason why this is one to look at is because this has the tightest correlation to mortgage rates. So I don't know if you've tried to get a mortgage, looked at mortgage rates, but I mean, when you have a non-conforming loan at, let's call it 3.5% on a jumbo mortgage, and then you have a conforming loan at 2.9%, you have some essentially free cash. Because if you think about it, you're going to take this out for a 30-year fix. And if it goes a little bit lower, you refinance. And if it goes higher, what do you care? Because it's fixed. So that's why you're getting this move into some of these homes, and you're starting to see some of this movement. The question becomes, what happens to the people that are already in their homes and underwater and can't afford it. Are we going to start to see a foreclosure rate? These are things that are starting to come to play on the mortgage side. But at the same time, these are people that essentially say, look, this is the safest place, and I don't care if you pay me something well below inflation. And if you have to think about inflation, these are people that are essentially admitting they're going to get less money at the maturity than they're getting in interest. So you're losing money if you buy this. I mean, those are risk adverse situations. Those are people that are essentially of trying to avoid, and just this moves to, instead of cash appreciation, just cash preservation. This is an inherent problem, and it really needs to be watched in terms of, well, what is going to happen if we get inflation starting to pick up, which we think is likely. How does this respond? And we've seen how it responded in the past with interest rates at 15%. So something to consider as we start looking at, let's just kick it off with the ECB balance sheet. And the reason why we're going to start with the ECB, which is just the European Central Bank, is because they've come out with some new stimulus. And now the stimulus came out on the 21st, which is 27 governments of the EU approved a 750 billion euro recovery fund. Now, it's split between what is going to be grants and then what is going to be actual loans. So the grants is going to be about 390 billion, and the loans is going to be about 360. So this is I shouldn't say well below. This is below what was expected in the market, and it's because you have a distinction between North and South. The northern countries don't want to essentially finance some of the southern behavior in terms of, if you want to think about the northern countries versus Spain, Portugal, or really what made up the pigs of 2011, which was Portugal, Ireland, Italy, Greece, and Spain. They want to say, okay, well, we need a way to manage this and pull back. And that's why this is a nice fiscal response. But the ECB continues to push money in. Like the ECB right now, they're at about 6.3 trillion as they continue to pump in, with total assets close to about 13.4 billion in just the past week on QE alone. So now we have the 27 governments giving some sort of fiscal response, but yet we have the ECB assets continuing to expand. Right now, it's at about 53% of Eurozone GDP. So just to consider the sheer size. And again, they've also been doing this since the beginning of about the end of 2014. And what do they have to show for it? There's been a very slow grind where there's been some economic growth, but really nothing that has been exciting, and to kind of show that they've gotten a return for what they've tried to do on the monetary policy level. And that takes us to the Fed. The Fed, you can see from 2009, the Fed started to create that easing, and you had a move up in total assets, but it pales in comparison to what we've done over the last 3 months now. And you could see that there's been a small dip lower, and it's just because of the repos that have adjusted, but you can see the sheer expansion is just, you almost have to laugh at it, because it's the sheer monetary value is truly fascinating. And again, it's been used to stimulate, but then the question is, how do you unwind it? We've seen potential unwinds in what became known as taper tantrums, where, oh, well, you can't take this away because of this, this, and this. If 128 months of expansion isn't enough to get you to slow down, I don't really know what is. And we can question what is expansion, how do we define it? I would define it differently, just because I don't think the expansion was as great, and maybe they agree, which is why you see the balance sheet the way it is. But at the same time, you have to consider, well, where do we go from here? The NASDAQ is up 19%. The market is now up 1.7%, given where we sit in the current world of COVID, with 75% of the population still behind some form of lockdown, yet we're approaching all-time highs. So you kind of see the disconnect in terms of the real economy versus the paper economy. And that's where we start going into the CAS index and some harder assets in terms of trying to monitor and look at what is actually moving. So here you can see June shipments, which consider where we were May into June, right? April was obviously tough. May was getting better. June was really the month where we had the most activity in terms of reopenings, movements, and you can see on a year-over-year level, we barely kind of blipped higher. It shifted higher, don't get me wrong, but again, it was still underwhelming in terms of what the movements are. And now intermodal got better, trucking went up. We had trucking, things moving on the road. But again, as we've talked about in the past, rail wasn't there and neither was shipping. And that's why when we go to shipping, you can see import-export activity off the West Coast. So this is looking at what's going into Asia, what's coming in from Asia. And you can see we're still down a little bit over 10% on an average basis. And you can see, and this is why I talk about this in terms of where we were in 2019 heading into 2020. And we started to get bearish and just looking at distillate and flows in July of 2019 because we started to see some shifts. And you can see that here in terms of where that shift really started to accelerate. And, we got a normal blip that you normally get as we go into the December season. But it was just a short-term blip and we started that downward move. This is something that's going to be problematic as we consider where we're going to sit over the longer term, because Asia just isn't coming back. And the reason why we talk about Asia is because they were the first in, first out of COVID overall in terms of massive lockdowns. And we're still not seeing that growth, which is why we look at Japan. So Japan, you can see here where 2020 sits. And it's important to kind of put this into context. And the reason why we use this chart is because you can see kind of where everything is bunched up. Now the outliers on the bottom is 2009, where you got this massive low because obviously 2009 was well below where 2008 was on specific periods. But then that top line, which is 2010, because on a relative basis, 2010 was way better than 2009. So if we take those out and we just look at 2019 versus 2020, which is that blue line, you can see that we've bottomed, but again, we're not seeing that move higher, which is concerning when you consider where Japan sits in the cycle of COVID, where, we've talked about China in our special report, where China sits, you're starting to see these laggards, you're starting to see this inability to get back to where you were pre-COVID, even though you've had all of these opportunities. And you could say, which is factual in its own right, that you're gonna, as long as your business partners and your trade partners remain in some form of lockdown, it's near impossible to get back to that normalcy. And, what does the second wave look like? Is there a second wave? Is this just the continuation of the first wave and we haven't seen a second wave yet? There's a lot of unknowns that are going to be problematic as we go into, the start of cold and flu season, as we go into, the September, October, November parts of when things start to heat up again on just the sickness. And there's going to be a lot that we're going to have to track and focus on. And that's why we look at exports, imports. We try to be agnostic and just look at the data. What is the data telling us on the underlying real economy? Because again, the paper market continues to move. There's continues to be, the ECB, the Fed, central banks continue to push money in, which is moving individuals into riskier assets, which in this case would be stocks. So again, there's going to be this, this move in terms of, well, what is the underlying economic engine growth on an earnings level, on a consumer level, on an investment, at a corporate level? These are things. And then obviously rounding it out, you have government spending, which we know is going to go higher, and then export import, which as we've seen continues to slow. So GDP is going to struggle through the end of the year. And I don't, based on some of this data, seeing a 2021 recovery as aggressive as being estimated is going to remain very difficult, especially when you consider where we came in from a weaker footing from 2019 into 2020. So again, thanks for watching. If you have any comments, please drop them in. We'd love to have some back and forth. Again, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again, and we look forward to talking to you again during the Primary Vision Frac Spread Count.